Hello everyone. Imagine earning money while you sleep. Sounds great, right? Today, we're diving into the world of dividend growth ETFs. Specifically, we'll explore the four best ones: SCHD, DGRO, VIG, and DGRW. These ETFs offer growth potential and steady income. But what makes them the best? You're about to find out. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. Let's start with SCHD, or the Schwab US Dividend Equity ETF. SCHD ETF specifically targets companies that consistently provide substantial dividends. The fund aims to maximize income for investors. SCHD ETF offers a strategic approach to investing in high dividend-yielding U.S. stocks, providing a reliable income stream and potential growth for investors seeking stability and returns in their portfolios. SCHD is a strategic investment choice. Investors seeking a balanced approach will find SCHD appealing as it marries capital appreciation with steady dividend income, ultimately promoting financial stability and growth. This dual focus makes it a robust option for both new and seasoned investors looking to enhance their portfolios. The result? A powerful investment choice for long-term investors. Next up is DGRO, or the iShares Core Dividend Growth ETF. DGRO redefines strategies for success. In this new landscape, DGRO's innovative mindset empowers not just growth but also resilience, ensuring that every challenge is met with a fresh perspective. With a commitment to excellence, they are poised to lead the way into a brighter future, inspiring others along the journey. It invests in companies that consistently increase their dividends. DGRO focuses on strategic investments. In pursuit of this mission, DGRO collaborates closely with its partners to enhance innovation, expand market reach, and drive long-term value creation. Ultimately, DGRO is dedicated to fostering a dynamic business environment that encourages sustainable growth for both the firm and its stakeholders. This ETF can be a valuable addition to your portfolio. In addition to providing steady income, this ETF presents a unique opportunity for investors aiming to grow their wealth over time. By carefully selecting high-quality assets, it positions itself as a strong contender for those seeking both stability and growth in their investments. Moving on, we have VIG, the Vanguard Dividend Appreciation ETF. VIG seeks firms that demonstrate consistent growth and commitment to shareholder returns. VIG prioritizes steady dividend growth. By focusing on companies with a proven history of increasing dividends, VIG ensures that investors can rely on stable income and long-term value growth, aligning perfectly with their financial goals and strategies. It prioritizes quality companies with strong fundamentals. With VIG, you're looking at sustainable growth. Finally, we have DGRW, the Invesco S&P Ultra Dividend Revenue ETF. DGRW prioritizes investing in robust, dividend-paying companies. DGRW seeks to maximize returns. DGRW not only emphasizes financial growth through dividends but also champions a strategic approach that fosters long-term wealth for its investors, showcasing a reliable path in today's volatile market. DGRW's focus on financial health fosters confidence in sustainable investments. This principle guides their investment strategy. DGRW not only prioritizes the well-being of their clients but also champions financial stability, ensuring a robust foundation for future growth and success in the market. This holistic approach embodies their commitment to integrity and excellence in investment management. Investing in DGRW means adding reliable income to your portfolio. So, which one should you choose? It depends on your goals. If you want a mix of stability and growth, SCHD might be your best bet. Prefer consistent dividend increases? DGRO could be ideal. If quality is key, VIG stands out. For reliable income, DGRW is a strong contender. Let's look at the dividend yield of each ETF. The SCHD dividend yield remains steady at 3.75%. This yield not only provides a reliable income source for investors but also reflects the company's commitment to returning value to its shareholders. As the market evolves, maintaining this percentage will be crucial for attracting and retaining investors in the long term. The DGRO dividend yield stands at 2.15%. The DGRO's consistent yield reflects its robust performance and commitment to providing shareholders with valuable returns. This figure is essential for investors looking for reliable income from their investments in the current market landscape. The VIG dividend yield stands at 1.68%. This yield suggests that investors can expect a modest return on their investment, reflecting the company's stability in paying dividends. As the market fluctuates, this yield can serve as a reliable indicator of VIG's financial health. The DGRW stock offers a yield of 1.48%. The DGRW ETF presents an attractive dividend yield, specifically at 1.48%, making it appealing for investors seeking regular income alongside potential capital appreciation. This combination positions it favorably in the market for those focused on dividends. Let's break down the fees associated with each ETF. Over time, even small fees can eat into returns, making them essential to consider for long-term investors. The SCHD expense ratio stands at 0.06%. This low percentage highlights SCHD's commitment to minimizing costs for investors, ensuring that more of your money remains invested rather than being consumed by fees. Ultimately, such efficient management can contribute to more favorable long-term returns. The DGRO expense ratio remains low at 0.08%. This low expense ratio makes DGRO an attractive option for investors, allowing them to maximize their returns while minimizing costs. Such efficiency is a hallmark of DGRO's commitment to delivering value, ensuring that every dollar invested works harder for clients' financial goals. The VIG expense ratio remains low. Maintaining a VIG expense ratio of just 0.05% ensures that we can operate efficiently while providing maximum value. This low ratio benefits our clients significantly, allowing them to allocate more resources toward their goals without worrying about excessive costs. The DGRW expense ratio remains competitive. With a low expense ratio of 0.28%, DGRW continues to provide a cost-effective option for investors. This attractive feature allows for enhanced long-term growth potential, making it a favorable choice in the ever-evolving market landscape. Here's a special tip. Consider combining these ETFs for a diversified approach. This can enhance both income and growth potential. Plus, you'll minimize risk by spreading investments across different sectors. In summary, SCHD, DGRO, VIG, and DGRW make perfect choices for any investor. They offer the potential for long-term growth and income. These ETFs can help you build wealth over time. As you navigate your financial journey, remember that knowledge is your greatest asset. Every step you take should be informed and intentional. Engage with experts, gather diverse perspectives, and stay open-minded. Keep learning. Ultimately, your financial success hinges on continuous growth and exploration. Embrace the wealth of information around you, and don't hesitate to seek guidance from a financial advisor. Their expertise can illuminate pathways that lead to financial stability and abundance. Stay proactive, stay informed, and thrive. Remember, investing is a journey. Do your own research and understand your goals. If you found this information valuable, please subscribe, like, and share with your friends. Stay tuned for more insights on investment strategies. Happy investing!